In 2008, while the S&P 500 was losing 37% of its value, Warren Buffett was writing op-eds telling people to buy stocks. Not because he was fearless, because he'd spent the previous 3 years building a cash position so large that a crisis wasn't a catastrophe. It was a shopping window. That's the part nobody talks about, not the buy low moment. The setup that made the buy low moment possible. There's a pattern that shows up every major market downturn, and it's not complicated once you see it. Wealthy investors don't just survive crashes better. They often exit crashes richer than they entered. And the gap between them and everyone else isn't primarily about portfolio size. It's about 3 structural behaviors that most people never adopt because they sound boring until the moment they become the only thing that matters. Here's the uncomfortable math first. During the 2020 crash, the wealthiest 1% of Americans held roughly 38% of all financial assets. By 2021, their share had grown. The crash didn't flatten them. It transferred more wealth upward. The 2008 crisis did the same thing. The decade afterward produced the longest bull run in American history, and the people who captured the majority of those gains were largely the people who had capital positioned to deploy when prices bottomed. This is the part that reads as rigged, and in some ways it is. But the mechanism isn't purely about having more money. It's about how that money is structured before the disruption happens. And that structure, the 3 core behaviors behind it, can be replicated at almost any scale, including scales most people would consider ordinary. The first behavior is what portfolio managers call liquidity positioning, and what the rest of us should probably call strategic patience made structural. Most people think about cash as what's left over after expenses. The wealthy treat cash as a dedicated asset class with a specific allocation percentage, not because cash grows, but because it preserves optionality. In a rising market, cash is the worst performing position in your portfolio. In a crash, it's the rarest and most powerful one. Here's the mechanism. When markets drop, assets don't just lose value on paper, they become difficult to sell without locking in losses. Someone holding 100% equities who needs liquidity during a crash is forced to sell depressed assets to raise cash. They're not just losing on paper, they're crystallizing the loss to fund current needs. Meanwhile, someone who enters the crash with a pre-allocated cash reserve doesn't need to sell anything. They can wait. Or better, they can buy. In game terms, this is having resources held back from the current engagement to deploy when the meta shifts. You're not hoarding. You're maintaining tempo options that other players have spent down. The replicable version of this doesn't require a large portfolio. It requires treating an emergency fund not as a safety net, but as a strategic reserve with an active purpose. Not money I'm not spending, but capital I'm positioning to deploy when prices drop. That reframe changes the behavior around it. You stop feeling like it's idle. It's standing by. Most financial advice says keep 3 to 6 months of expenses liquid. That's fine as a floor. But the structural behavior of wealth is closer to maintaining a meaningful percentage of total net worth. Some advisors suggest 5 to 10% in assets that can move fast, and treating that allocation as permanent, not temporary. The second behavior is harder to see because it looks like diversification, which everyone claims to do. But it isn't quite diversification. It's what might better be called uncorrelated income architecture. Diversification, as most people practice it, means holding a mix of stocks, maybe some international exposure, maybe some bonds. The problem with this during a real systemic crash is that correlations spike. Assets that normally move independently start moving together because the underlying pressure, panic selling, margin calls, credit tightening, affects everything simultaneously. In 2008, the financial crisis caused correlations across asset classes to converge in ways that made most diversified portfolios look nearly identical. What wealthy investors hold that most retail investors don't isn't more asset classes. It's income streams that don't move with financial markets at all. Business ownership, real estate with long-term tenants, royalties, private credit. These don't become worth zero because the S&P dropped 40%. Their cash flows may compress, but they don't disappear on a Tuesday afternoon because of sentiment. The insight here isn't you need to own businesses and real estate. The insight is about the underlying principle. Resilience doesn't come from holding more things in the same category. It comes from holding things whose value is determined by completely separate mechanisms. At an ordinary scale, this looks like a side income that isn't tied to employment, skills that can generate freelance revenue, a small ownership stake in something that generates cash flow independent of stock market performance. None of these are glamorous. All of them dramatically change how a crash feels structurally because you have cash flows that continue even when your portfolio statement looks ugly. The third behavior is the most counterintuitive and the most misunderstood. It has nothing to do with what you buy or how you allocate. It's about decision architecture. Wealthy investors, particularly those who have built substantial wealth rather than inherited it, tend to have pre-committed decision frameworks in place before volatility hits. They're not making allocation decisions in real time during a crash. Those decisions were already made and written down before the situation was emotional. This sounds procedural. It is procedural, and that's exactly the point. When markets drop 20%, the psychological pressure to do something is enormous. Sell now before it gets worse, or buy now before it recovers. Both impulses feel rational. Both impulses, when acted on without a pre-committed framework, tend to produce worse outcomes than doing nothing. The research on this is consistent. Retail investors who actively trade their portfolios during high volatility periods underperform the market significantly. Not because they're unintelligent, but because human decision-making degrades under uncertainty and time pressure. What the wealthy have isn't better instincts. They have externalized the decision before the emotion hits. A written investment policy statement. A rebalancing trigger that auto-executes at predefined thresholds. A simple rule. If X drops below Y, I buy Z. These systems aren't sophisticated. They're just outside the emotional loop. If you've ever played through a difficult segment with a strategy locked in before the chaos started versus trying to figure out your build mid-fight, you understand the mechanical advantage here. The preparation isn't about prediction. It's about reducing the number of decisions you need to make in a degraded cognitive state. The replicable version of this is simple to describe and genuinely difficult to do. Write down your rules before you need them. Define in advance what you will and won't do if your portfolio drops 15%, 30%, 50%. Define your rebalancing triggers. Define your liquidity position floor. Put it somewhere you'll actually see it during a crisis. The goal isn't to have the perfect strategy. The goal is to not override your own strategy when it's hardest to stick with it. None of this is secret. The basic framework of these three behaviors, liquidity positioning, uncorrelated income, pre-committed decision rules, is documented across decades of behavioral finance research and investor biographies. It isn't hidden. But notice what it doesn't involve. It doesn't involve picking the right stocks. It doesn't involve timing the market. It doesn't require special access to institutional deals or insider information. It requires structural setup that most people never build because it doesn't feel urgent when things are good, and by the time things are bad, the window to build it has already closed. The real advantage of wealth during crashes isn't purchasing power, it's preparation window. The wealthy build these structures years in advance, not because they knew a crash was coming, but because they built them as permanent features of how they manage money. The crash just revealed the architecture that was already in place. Which brings us back to Buffett in 2008. He wasn't brilliant in September and October of that year. He was prepared from well before. The move he made during the crisis, deploying capital into Goldman Sachs, GE, and others on terms no ordinary investor could access, was only possible because of decisions made years earlier about what percentage of Berkshire's balance sheet would always remain liquid, always remain deployable, never be fully committed regardless of how good conditions seemed. The opportunity only looks like luck from the outside. From the inside, it was structure. If this kind of breakdown is the kind of thinking you want more of, not predictions about where the market's going, but analysis of how financial systems are actually designed and how to position yourself within them. 8-Bit Economics drops new videos every week. We don't trade in hype or market calls. We strip complex financial mechanisms down to their core code and show you how the game actually works. Subscribe if you're building this kind of thinking. Like if something here shifted how you see it. And leave a comment with the part that landed differently than you expected. By the time everyone sees it coming, the smart play is already over. The deepest takeaway here isn't about crashes at all. It's that the behaviors that create financial resilience aren't activated by volatility. They're built during calm. The window to adopt these structures isn't before the next crash. It's now, when they feel least necessary, which is exactly when they're most buildable. That's not advice. That's the mechanism. What you do with it is your decision architecture.